Here's our roadmap for this session. We'll start with the trend-following strategy itself, then discuss the singular power of price, take a really quick channel break, dive into the psychology of winning, outline how to manage your portfolio risk, and finally, wrap up with our key takeaways.
Okay, part 1, the trend-following strategy. Let's get right into it.
So, what if everything Wall Street taught you is just flat out wrong? Conventional wisdom preaches buy low, sell high. I mean, it sounds great on paper, right? But what do you actually do when an asset hits an all-time high, or when it plummets to rock bottom? If you want the actual results of the professionals, you kind of have to throw that conventional Wall Street wisdom right out the window. Let's break down the term itself. Every trader needs a trend to profit. Basically, if the market goes nowhere, well, neither does your account balance. But the following part, that is the absolute key here. You don't force the market, and you certainly don't predict it. You wait patiently for a definitive shift, and then you just jump on. You're entirely reactive, never predictive.
Moving on to part 2, the power of price.
Think about the difference between fundamental analysis and trend following. Fundamental analysis completely bogs you down in crop reports, PE ratios, and central bank gossip. It's exhausting. Trend following just ignores all of that noise. It relies on statistically validated rules based on one undeniable absolute metric: price. There are no forced daily goals here. If the price doesn't move, you literally do nothing.
Legendary trader John W. Henry puts it perfectly. He notes that you don't need a supercomputer to see the capital flows create these massive extended trends. Central banks, for example, don't raise rates one day and drop them the next. They raise, raise, raise. Human behavior practically guarantees these sweeping trends, so your only job is just to ride them.
So the golden rule here is to respond to change, don't predict it. When your entire system is built from the ground up to respond to price changes, the exhausting game of prediction becomes completely irrelevant. The avalanche of daily financial news? That just complicates things. Fundamentals can't tell you the exact mathematical moment to buy, but price action absolutely does.
Think about catching a falling knife for a second. If you try predicting the exact bottom of a 60% tech stock crash, you're playing a fool's errand. Has the bear market run its course? Honestly, who cares? Trend followers don't forecast. They follow the trend down, shorting it all the way until the price definitively reverses.
All right, part 3, a quick channel break for Definite Books.
I want to quickly pause and mention that this explainer is created for the 10 Minutes Book Summary Definite Books YouTube channel. Please make sure to like and subscribe to the channel for more explainers like this. Your support really means everything to us.
Getting back into it with part 4, the psychology of winning. Here is a hard truth. Your personality dictates your profitability. If you're out here trading for an adrenaline rush, the best system in the world won't save you from ruin. The text highlights that impulsive traders crave novelty. They let neurotic emotions take over after just a single loss. You absolutely must align your strategy with your psychology, or your unmet emotional needs will actively sabotage your own portfolio.
Original market wizard Ed Seykota hit the nail on the head when he said, all profitable systems trade trends. It's basically a simple universal law of physics in the market. You don't need to be some hyper-creative genius. In fact, overanalyzing is usually your downfall. You simply need the disciplined capacity to execute the plan.
Look, if you're faithfully executing a solid system, your day-to-day trading should actually be incredibly boring. If you feel a massive adrenaline spike every time you open your brokerage app, you're either doing it wrong or you need to switch to decaf. Great trend followers find their excitement outside of market hours. They do not use their equity curve as an amusement park ride.
Now for part 5, managing your portfolio risk. Managing what we call portfolio heat means accepting that your true risk tolerance must dictate your position sizing. Every single trade with a stop loss is a calculated bet. The more capital you risk, the hotter your portfolio gets. Taking massive, bold bets doesn't make you a genius, guys. It just guarantees the heat will eventually burn your account straight to the ground. Mark Douglas brilliantly points out that you are constantly balancing on a razor's edge here. You're trying to find that mathematical sweet spot of risk versus reward. Risk too little, and transaction costs will eat you alive. Risk too much, and you face the spectacular ruin of going bust. Ruthless money management is the unglamorous, strictly mathematical secret to actually making millions.
Finally, part 6, conclusion and channel support.
Trend following has endured for decades precisely because it ignores the financial talking heads and yields only to the undeniable truth of market price. It's a totally anti-fragile philosophy. It doesn't care if a market is rocketing to the moon or crashing to zero. There's always a trend, and there's always a profit to be made if you respect the rules.
By surrendering the need to predict the future, you empower yourself to profit from reality. So ditch the fundamental forecasting. Stop obsessing over the Federal Reserve. Just track the price. Match your system to your personality. Strictly manage your portfolio heat. And simply follow the trend, wherever it leads you.
Before we wrap up, a quick reminder that this explainer is created for the 10 Minutes Book Summary Definite Books YouTube channel. Please like and subscribe to the channel for more explainers exactly like this. It truly helps us keep bringing you these deep dives.
The big money is made by identifying the trend and sticking with it. Honestly, the hardest part isn't the math at all. It's abandoning your ego and admitting you aren't smarter than the market. So the only question left is, are you ready to stop forecasting and start reacting? Thank you so much for joining us for this explainer, and we will see you next time.